Markets, which are higher across the board, the S&P and Nasdaq trying for an 8-day winning streak. And there's a lot for investors to digest this week with Fed minutes on Wednesday, Jackson Hole kicking off on Thursday. Brian Jacobsen is chief economist at Annex Wealth Management. Brian, it's nice to see you today on Power Lunch. Jerome Powell doesn't have the best history here at Jackson Hole. I mean, he's definitely certainly injected volatility into markets in prior or past performances or speeches, I should say, at Jackson Hole. What are you expecting this time around?
Yeah, I think that it could be something very similar this time. It seems like there's very high expectations that he is going to lay out that they are planning on cutting rates. Maybe he's going to talk about the cumulative progress that they've made in the battle against inflation, recognizing that the labor market has come back into better balance because, the unemployment rate has risen, job openings have declined relative to the number of people unemployed. But beyond that, I'm not sure he's necessarily going to deliver on what the market is hoping for, which is like a clear signal that they're planning on moving, very quickly or by a large amount. Because here at Annex, on our investment committee, we think they'll deliver a 25 basis point cut on September 18th, and then maybe it's 25 basis points every meeting pretty consistently. And honestly, that might not be enough to really placate the markets.
Markets have done exceptionally well over the last 2 weeks. S&P 500 is up 9% since that August 5th low. So if he does hint at a 25 basis point rate cut later this week, will that be enough for markets to continue, to continue to move higher?
In the short term, perhaps not. I think that actually if he delivers on that messaging of 25 basis points, there's enough people who are hoping for maybe a bigger statement about 50 basis points that they could be a little disappointed. And so prices are always set on the margin by the marginal buyers and sellers. And so if they're really disappointed in that move, we could see a little bit of a pullback. Now, one of the things that I'm a little bit more concerned about is when we do get that actual cut, is whether or not it proves to actually be not the giant panacea that everybody is hoping for. Yes, every little rate cut helps people who have the debt that's floating rate. But really, if you think about 25 basis points, is that enough to move the needle on a person's decision in order to refinance a mortgage, get out of a 3% 30-year fixed rate that they have to go buy a new home, businesses to invest? And so perhaps the rate cut itself isn't necessarily going to deliver the economic stimulus that a lot of people are hoping for.
Brian, I wonder, though, does Powell really have to do that much? Because a couple of weeks ago, the market was down on Fed discipline, right? After that, before the jobs report and especially after. But then it was up on the data, right? People were saying, oh, emergency meeting, the Fed has to do something. Well, maybe the Fed doesn't have to do as much as some people thought. Does he now have to signal that the Fed is willing to do as much as people falsely hoped he would do when they thought that the sky was falling?
Yeah, maybe he's actually going to push back on that idea that the Fed needs to do an outsized or supersized move with the Fed cuts, mainly because in the past when they've had to do those emergency meetings or something bigger, it's because financial conditions had been seizing up. And actually, even though prices were down, still markets were fairly orderly. It's not as though we were seeing credit spreads blowing out or that there were a lot of failed trades, especially repo markets and things like that. So there was really no justification for some sort of emergency move by the Fed, especially since the data wasn't really all that weak. It was slightly weaker than expected, but it's not like all of a sudden, we saw a 100 basis point increase in the unemployment rate or something that would be really shocking. It was, I think, really in line with the Fed was expecting, maybe a little bit worse than anticipated, but nothing that really merited some sort of big move by the Fed.